कि इस क्वेश्चन में जो रिक्वायरमेंट थी मार्जिनल कॉस्टिंग और एग्जॉर्प्शन कॉस्टिंग की इनकम स्टेटमेंट आपने बनानी थी. The following budgeted information per unit is available. Selling price per unit is $20. Direct material cost is 6. Direct labor cost is $3. This is variable cost. Both of them are variable cost. Budgeted production. Let me just move this fixed cost calculation. Okay. The budgeted production was 20,000 units and the budgeted fixed overheads 100,000 per month. At 1st January there was no inventory held. Opening inventory kuch bhi nahi. We are making income statement for January and February. Sales units are 15,000, production 18,000 and the fixed overheads are 100,000. These are the actual results. And for February, sales units are 21,000, production units are 18,000 and fixed overheads are 100,000. So we are required to prepare the marginal costing income statement for Kevin in part C. The selling price per unit is given in the question 20 and the number of units are 15,000 for January. So 20 into 15,000, your sales value will be 300,000 for January. Sales less cost of sales. Opening inventory, there was no units in opening inventory at the beginning of January, so opening inventory will be 0. And the production units. In marginal costing, we just multiply the variable cost per unit with the production units. Variable cost is direct material and direct labor, which is 6 plus 3, $9. And the production units for January are 18,000. So 9 into 18,000, the total production cost is 162,000. How to calculate the closing inventory units? Look here, you produced 18,000 units and you only sold 15,000 units. 18 minus 15 produced 18, sold 15. It means you will have 3,000 units in your closing inventory. And what will be the value of these 3,000 units? Again, it will be multiplied with the variable cost only, which is 6 plus 3, $9. So 3,000 into 9, the value of closing inventory is 27,000. You can calculate your cost of sales now. Production cost minus closing inventory cost. The cost of sales is 135,000. Sales less cost of sales, you will get contribution. We know the format of marginal costing. Sales minus variable cost, we will get contribution. Now the fixed overheads are 100,000. Actual fixed overheads are 100,000 for January. So your profit will be 65,000 in January. Now for February, again the selling price per unit is still 20, but the number of units sold in February are 21,000. So 20 into 21,000, your sales value will be 420,000. In cost of sales, now this closing inventory of January will become the opening inventory of February, 27,000. Production cost is 9 into 18,000 again. Your variable cost is 9 and number of units produced are 18,000 again. So the total production cost is 162,000. Now there is no unit in the closing inventory because in opening inventory you had 3,000 units, you produced 18,000 units, total units are 21,000 and you have sold 21,000 in February. So there will be no inventory, closing inventory in February. So the cost of sales will be 27 plus 162, 189,000. 420 minus 189, your contribution is 231,000 unit, $231,000. 231 minus fixed cost are 100,000 even in February. So your profit will be 131,000. This was the answer of marginal costing. The next is absorption costing. The sales value will remain same, either it is marginal or absorption. So sales for January and February will be 300 and 420 as you found them in marginal costing. Again in January there will be no opening inventory. Now the production cost will be not the variable cost only, but you will also add the fixed cost per unit. How to find the fixed cost per unit? Your budgeted overheads were 100,000 and your budgeted units were 20,000. It means the overhead absorption rate was $5 per unit. You add $5 with variable cost, your total cost per unit will be $14. Now multiply 18,000 with $14, you will get 252,000. This is your production cost. Again in closing inventory, your units were 3,000 because you produced 18,000 and you have only sold 15,000 units. So you had 3,000 units in closing inventory. Multiply them with $14, which is your total cost per unit. Your closing inventory value will be 42,000. Production minus closing inventory, your cost of sales is 210,000. Sales minus cost of sales, your you will get 90,000. And now you will adjust it for under and over absorption. For you should remember the rule of under and over absorption. When you produce less units, less than planned, it will be under absorption. The conditions for under absorption were production is less than actual production is less than planned production, or actual overheads are more than planned or budgeted overheads. So in this case, overheads are same, budgeted and actual overheads are same, but production is less than the planned. Actual production is less than the planned production. It means this is under absorption. Okay, so 18,000 is your actual production and your planned production were 2,000. So under absorption is 2,000 units are less than the planned production, and the overheads per unit are $5. So we will multiply $5 into 2,000 to find the under absorption of overheads. The total under absorbed overheads are 10,000. We always deduct under absorption of overheads from this gross profit to get the net profit, which is 80,000. If it is over absorption, we will add it to the gross profit. Okay, so the profit for January will be 80,000. Then for the next month, this closing inventory will become opening inventory. Production cost is again same because you produce 18,000 units also in February, and there is no closing inventory because now you have sold all the units. Your production was 18, your opening inventory was 3, and you have sold 21,000 units in February. So the total cost will be 294,000. Your gross profit is 126,000. Again, you have underproduced 2,000 units. Look here, again in February you have 18,000 units of production, and the fixed cost per unit is 5. So 18,000, 2,000 is the difference. 2,000 into 5, again your under absorption is 10,000. 126 minus 10, your profit is 116,000. The next requirement was reconciliation of profit for January only. So it is the format is profit under marginal costing. In marginal costing, the profit for January was 65,000. We always add fixed cost absorbed in closing inventory. The fixed cost absorbed in closing inventory, the closing inventory was in January, the closing inventory was 3,000, and the fixed cost per unit was 5. So 3,000 into 5, fixed cost absorbed in closing inventory is 15,000. It is only fixed cost, not the total cost. Okay, less fixed cost in opening inventory. There was no opening inventory in January, so the answer is 65 plus 15, which must be equal to profit under absorption costing. So we can see the profit under absorption costing in absorption costing is 80,000. It is reconciled.